Bond yields have spiked on the 10-year Treasury, rose from about 160 to 190 last week. Pretty healthy move to the upside. And while we think we could see higher yields, we're still in the process of putting in a large base. Hi, this is Mark Arbiter with S&P's Chart Room. Taking a look at a daily chart of the 10-year Treasury yield, you can see that we've had this nice spike here from 160 up above the 190 level. However, this is all in the process of putting in what we think is a fairly large base that we've been talking about. We have the left shoulder put in here, the head was traced out, and now we could be working on the right shoulder. We don't know if this is the true neckline yet. It's very possible that we could run up above the 2% area and put in the second point for the neckline, which would make it a little flatter. However, you know, this trend line here is probably important for more upside in yields. Comes in around the 2% level. But the key longer term, we think, for a real breakout in yields is this 2.4% level. We need to break above that level, we think, to complete this very large inverse head and shoulders. And once we do that, which we think will be probably later this year or early next year, we could then see a measured move about 100 basis points. We bottomed at 1.4, this would be 2.4, so we could see a 100 basis point move off the top of that 2.4% level up to about the 3.4% area. Taking a real long-term look at bonds, we go back to about 1998 here. You can see that we've been in this very wide bullish channel with respect to yields. Is bullish because prices have been rising as yields have been falling. And if we look at this potential inverse head and shoulders, we see how small it is relative to the massive move we've seen in bonds. If we go back actually to 1981 when this bull market started, and even if we were to see a measured move from this potential breakout here up to the 3.4% area, we'd still be in this very bullish long-term channel. So the trend in bond yields is still lower from a long-term perspective. We kind of doubt that this 1.4% level will be taken out to the downside, but stranger things have happened in this 3-decade plus long bond market, bull market. This has been Mark Arbiter with S&P's Chart Room.